One of the world's largest investment banks just made a prediction about gold that flies in the face of everything mainstream financial media is telling you right now. And if they're right, the wealth protection strategy most people are ignoring could turn into the defining investment move of the next decade. But here's what most people miss. JPMorgan didn't just casually mention this. Their research team, the same people who helped manage trillions in assets, issued this as a serious, data-backed projection. And the moment it hit, the reaction was silence. Crickets. The mainstream financial press barely touched it. Which means right now, in this exact moment, there's a massive gap between what the institutions know and what retail investors believe. And that gap is exactly where opportunity lives. So stay with me, because in the next few minutes, I'm going to show you what JPMorgan actually said, why they said it, and more importantly, why the timing of this prediction could fundamentally reshape how you should be thinking about your money. Let's start with the reality most people are living right now. You've probably noticed something strange over the last few years. The stock market has hit all-time highs. Real estate is unaffordable. Your paycheck doesn't stretch as far as it used to. And whenever you try to talk to someone in finance about it, they tell you everything is fine. Growth is strong. Inflation is under control. The Fed has everything handled. But you know something doesn't add up. You feel it. Because simultaneously, we're watching governments borrow at levels we've never seen before. Central banks are in a weird holding pattern with interest rates. Geopolitical tension is rising. And despite all the official reassurances, more and more ultra-wealthy individuals are moving money into gold and alternative assets. So which reality is actually true? Are we in a stable, healthy economic system? Or are we sitting on something far more fragile than we're being told? The honest answer is, the official narrative and the real-world behavior of smart money have diverged. And that divergence always matters. Here's where the JPMorgan analysis becomes important. Their research suggests something that sounds almost absurd if you've been following mainstream finance. Gold could potentially reach price levels that would represent a massive re-rating of the precious metals complex. We're not talking about small percentage moves. We're talking about a fundamental reassessment of what gold is worth in the system. But that's only the surface explanation. The real mechanism is much deeper, and it goes back to something most people don't understand about how money actually works. Let me break this down step by step. Step 1. Understand what gold actually is in the modern financial system. Gold is not just a commodity. It's not just jewelry. Gold is a form of monetary insurance. It's the asset that central banks hold when they don't trust the currency they're supposed to be managing. It's what you own when you're saying, "I don't believe the promises being made about this piece of paper." Step 2. Look at what central banks have been doing. Over the last several years, central banks, especially non-Western central banks, have been buying gold at the fastest pace in decades. China, Russia, India, the Middle East, they're accumulating, quietly, deliberately, without making a big announcement. Why would they do that? Because they're positioning for a world where the current monetary system becomes less stable, where currencies matter less, where hard assets matter more. Step 3. Now add the actual numbers. Global government debt is at record levels. The Federal Reserve created more money in 2020 and 2021 than it did in its entire 107-year history before that. That's not hyperbole. That's quantifiable fact. We flooded the system with liquidity during a crisis, and we never fully drained it. Step 4. Inflation came roaring back, and this time it wasn't just temporary. Wage pressures remained. Supply chains got worse before they got better. Geopolitical disruptions made energy and commodities more volatile. Suddenly, the idea that inflation would be transitory looked, well, wrong. And here's the final connection. When currencies lose purchasing power, when people stop trusting that a dollar will be worth what they were told it would be worth, what do they buy? They buy gold. Not because gold is going up in some absolute sense, but because gold maintains its purchasing power while currencies deteriorate. This isn't theoretical. History shows this pattern again and again. Look at the 1970s. After decades of Bretton Woods keeping currencies tied to gold, the system broke down. Governments ran massive deficits. Inflation spiraled. And what happened to gold? It went from $35 an ounce in 1944, a fixed price, remember, to over $850 by 1980. That wasn't gold getting more valuable. That was the dollar getting weaker. Look at 2008 and 2009. The financial system nearly collapsed. Central banks panicked and printed money. Currencies weakened. And gold? It rallied hard, moving from under $700 toward $1,000, then eventually much higher. Look at the post-2020 era. Central banks engaged in unprecedented monetary expansion. Real interest rates, the actual purchasing power you earn on savings, went deeply negative. And gold moved from 1,700 to 2,000 to 2,100 and beyond. The pattern is consistent. When monetary systems become stretched, when currencies lose credibility, gold re-rates higher. But here's where everything changes. The current moment is structurally different from any of those previous periods. And that's exactly why JPMorgan's analysis is getting attention from people who understand macro dynamics. Let's be clear about what we're dealing with. First, the debt trajectory is unsustainable. The US government is not just running deficits, it's running structural deficits that have become part of the political system. Neither party can cut spending meaningfully. Both parties want to spend more. That means debt will keep rising, interest on that debt will keep rising, and at some point, the math breaks. Second, the central banks are trapped. They can't raise rates too much because that would crash asset prices, break the banking system, and cause a recession. But they can't keep rates too low because that enables inflation and currency weakness. So they're caught between two bad choices, and that never ends well. Third, geopolitical fragmentation is accelerating. The dollar's dominance is being challenged. BRICS nations, the Middle East, and other regions are actively trying to reduce their dependence on the US currency for international trade. That sounds abstract, but it means less demand for dollars. And less demand for dollars means less confidence in dollars. Fourth, the energy transition is real, and it's creating supply pressures in metals and resources. Whether you believe in climate change or not, trillions are flowing toward renewable energy. Solar panels, wind turbines, batteries, electric vehicles, they all require massive amounts of copper, lithium, cobalt, and other metals. Gold is getting caught up in that supply squeeze too. Fifth, demographic shifts mean governments will need to spend more on healthcare and pensions. That's another structural driver of deficits and currency pressure. So the question isn't whether inflation could return, it's whether governments and central banks have any tools left to prevent it. And the honest answer is, probably not without major disruption. So what does JPMorgan actually think happens next? Their analysis suggests we could be looking at a re-rating of gold that takes it to levels many people would consider extreme. We're talking potentially 3, 4, or even 5 figures per ounce in nominal terms over the next decade or so. Now, before you dismiss that as crazy, understand what that actually means. If gold moves to $5,000 an ounce, that doesn't mean you're getting rich overnight. It means the purchasing power of the dollar has declined so much that more dollars are needed to represent the same real value. But here's the critical insight. While the nominal price goes up, you, the person holding gold, maintain your purchasing power. Everyone else holding paper currency gets diluted. The timeline probably looks something like this. In the near term, the next 12 to 24 months, you'll see gold trade in ranges with periodic breakouts. Investors will test new highs, skeptics will declare it a bubble, and the Fed will continue walking the tightrope between managing inflation and avoiding a crisis. In the medium term, 2 to 5 years, if growth disappoints, or if geopolitical tensions spike, or if inflation reemerges, central banks will probably shift toward easier policy. They'll tell you it's temporary. It won't be. And gold will start moving meaningfully higher as real interest rates turn negative again. In the long term, 5 to 10 years, the structural issues we've discussed will become undeniable. Deficits will be massive, debt will be enormous, and the question won't be whether gold is too expensive, it will be how expensive it needs to be to reflect the actual loss of purchasing power in fiat currencies. So what should you actually be watching? First, real interest rates. This is the spread between the nominal interest rate and inflation. When real rates are positive, you're getting paid to hold cash. When they're negative, cash is losing value. JPMorgan and other smart money watch this obsessively. When real rates turn deeply negative and stay there, gold historically accelerates higher. That's a signal. Second, Central bank gold buying. Keep track of announcements from major central banks, especially non-Western ones. China, Russia, the Middle East. When they're buying, they're positioning. When positioning increases, it often precedes currency stress or geopolitical moves. That's another signal. Third, dollar strength relative to other currencies. A weakening dollar is typically gold positive, but watch the specific dynamics. Is the dollar falling because the Fed is printing money? Or is it falling because other nations are reducing their reliance on it? The reason matters for what comes next. Fourth, geopolitical flashpoints. Oil prices, sanctions, trade wars, military buildups. These create uncertainty, and uncertainty drives people toward gold. It's not about predicting what will happen, it's about recognizing that when the world gets unstable, safe haven assets matter. Let me be direct about what this all means for you. We're living through a period where the old rules of macro investing are being tested. The assumptions that worked for 30 years, stable currencies, steady inflation, predictable central bank behavior, are breaking down. JPMorgan's analysis on gold isn't a prediction that gold will somehow magically soar. It's a recognition that when monetary systems experience the kind of stress we've built into the structure, hard assets re-rate. It happened in the 70s. It happened in 2008. It's happening now, just more slowly than most people expect. The reason most people miss this is simple. They're watching the noise. They're listening to headlines about the strong dollar and the resilient economy and the soft landing. They're not watching the actual behavior of people who manage trillions of dollars. Those people are quietly buying gold. Those people are diversifying away from currency concentration. Those people are positioning. And here's what most people miss about those people. They're usually right. Not always. But when the structural incentives are aligned, when the math says the system is stretched, when the geopolitics say stability is deteriorating, when the central banks say monetary policy is constrained, smart money follows the logic. Gold isn't a lottery ticket. It's not a get-rich-quick scheme. It's a wealth preservation tool. It's what you hold when you're saying, I believe in my own purchasing power more than I believe in the promises of central banks. And if JP Morgan is right, and if the next decade unfolds the way the structural data suggests it might, holding some gold won't make you wealthy. But it might make sure you don't become poor while everyone else is debating whether the economy is really in trouble. The moment we're in right now is genuinely important, not because gold will definitely go to $5,000, but because we're at an inflection point where institutional quality analysis is pointing toward a significant re-rating of precious metals, while retail investors are still debating whether gold is a good investment at all. That gap, between what smart money is doing and what most people believe, is exactly the gap that precedes major moves. JP Morgan's analysis is telling us something clear. They think gold matters more in the coming years than it did in the past. They think currencies matter less. They think real assets matter more. Whether you choose to hold gold or not is up to you. But ignoring what trillion-dollar asset managers are actually doing and continuing to bet everything on traditional financial assets while debt spirals and currencies weaken is a choice too. And that choice might cost you more than you ever realize. If you want more deep market analysis like this, the kind of macro insight that helps you understand what smart money is actually doing, subscribe and stay close to the channel. Because in a world of noise and noise, clarity is everything.